So we just want our clients and viewers to know that we're here, we're fully functional. We've been practicing this for years actually, where we can have all of our team members working remotely. Actually, Mike and I are the only people in our headquarters right now. And we're able to run these videos and run our operation without having to all be in the same office. We worked really hard on our technology solution and spent a lot of money and a lot of time to sort of disaster prep for any types of events like this. So we want you to know that we're here, we're monitoring portfolios regularly and the markets, and we plan to be bringing you regular updates, and we want to make sure that you know how we're viewing this. Over the weekend, there was quite a bit of activity. We had the Fed come out and fire a pretty large bazooka.
They cut their target interest rate down to a range of 0 to 0.2%, effectively 0. So you had 5 years of interest rate increases and monetary policy undone in the course of 2 weeks,
Right.
basically. And then also announcing $700 billion at least of quantitative easing, asset purchases, 1, treasuries, 2, agency mortgage-backed securities, over an indefinite time period. You know, it could all be used up today, or it could be stretched out over a course of 3 months. That wasn't as important as the message, which was basically, we are here,
Right.
we are going to act boldly and swiftly with intent, and we are going to do everything in our power to make sure this doesn't turn into a full-blown financial crisis.
Right.
And then also noting the coordination. This was not just the Fed. This was a coordinated effort across global central banks to provide stimulus and open US dollar swap lines with 5 other major global central banks to make sure that there aren't any US dollar funding issues around the world. So basically they busted out the 2008 playbook.
On steroids. I mean,
exactly.
It's even more serious than that. And the IMF came out with a $1 trillion loan package this morning. So all the central banks' monetary policy are really focusing on making sure this doesn't morph into a crisis.
Right.
Which is what we expected. Like, they've been through this before. They know what to do. I think that should give people a lot of confidence that they're not going to let the financial system crumble in the face of this virus.
That's right.
One of the things that we didn't get a lot of information on was a fiscal package. And as we talk about sort of the path forward, there's the health crisis, there's the fiscal support, to support the economic damage, and then the monetary support. And we've sort of, if we think of them that way, we're sort of funneling it backwards.
Yeah,
but
exactly.
On the fiscal side, tell us about what we should be looking for there.
So one, we should be looking for more. Steps have been taken to address things like sick leave, address things like co-pays for coronavirus testing. But effectively, what we'll need is some type of a bridge or direct fiscal stimulus package, especially for all the folks who are in the leisure and hospitality and food service business are facing potentially, we don't know how long, but we'll say 4 to 8 weeks to be conservative, where their services may no longer be needed.
Right.
And so how are you going to compensate those folks, make sure that they can continue to pay their bills? So hopefully once we sort of flatten the curve and get over this virus situation, their financial situations are in shape and the companies that employ them are in a position to bring them back. That is so critical for a V-shaped recovery, and that is not something that can be done on the monetary side. It has to be a fiscal solution. So those types of targeted solutions in a big way are still what needs to happen.
And we should hear more this week on potential solutions there. So as they develop, we'll bring those to you and give you our take on those. But the reality is the virus will eventually subside and economic activity will resume. And as long as the damage in the interim period isn't too significant, as you said, we should be sort of springing right back.
Exactly. The ability to spring back out of this is what's required, is that individuals and businesses, their balance sheets aren't permanently damaged.
Right.
As long as they have capacity to, when we come out of this situation, oh, you know what, I do have the funds to go out and make that trip. or businesses say, you know what, my budget for the year is still somewhat intact. I do have money to spend.
Right.
That's how event-driven recessions typically work, and event-driven recessions typically follow a V or a U-shaped pattern. As long as balance sheets aren't permanently put in disrepair, you can still hope for that U-shaped or V-shaped recovery. So it's very important. I know a lot of these measures seem like bridges and Band-Aids, but bridges and Band-Aids are very important.
Yeah.
They're very important, especially
sure
if this is a very deep but brief economic recession, and individuals and businesses can get a bridge just to get over it.
Yeah.
That's how you make sure we can come back from this, as quickly as it deteriorated.
And the interestingly, this morning, listening to some of the politicians talk, there's a good, strong understanding of that need, that they recognize that's where they need to build a bridge, that's where they need to put the Band-Aids, which seems a lot more timely and realistic than it did in the financial crisis. I think you'll have less argument and more action.
Yes.
That's our hope.
Yes.
And there's also been hints of direct lending to businesses by either the government or the Fed to support those types of emergencies if they arise.
And we've seen the banks, so reserve requirement for the banks, the major banks were cut to zero.
Right.
So they have more funds to lend, and all the major banks have said that they're going to suspend share buybacks to make sure they have more capital to lend.
Yeah.
So you can definitely start to get this sense like, hey, we're all in this together. This is a common enemy, and we are a resilient people and a resilient economy, and we're going to get through it.
So one of the things that, just to let you know, we were actually buying stocks on Friday, and I bought some stocks this morning. So, talk about the values we're seeing and how they relate to historic opportunities.
Yeah. We have a screen of individual stocks that we run on a daily basis, and it's the same types of brand names coming up over and over and over again. Right. Names that are in the dividend portfolio, for example, like a Coca-Cola, a Nestle, a Target, a Rio Tinto, all these names that, when you look under the hood, you see not a lot of debt, a history of growing the dividends. These companies are going to be here 1 year, 3 year, 5 year, 10 years, 20 years from now. And you see them down 20 to 50% from all-time highs. And it puts a lot of things into perspective. It takes you out of the short-term news cycle and allows you to focus far less on, I need to try to time this thing perfect.
Right.
If these companies, if you go back through their history and you say, I'm going to buy anytime they're down 40 to 50% from their all-time highs, 3, 6 months, 12 months after that, your money good.
Yeah.
It works out in almost every instance. And then you think how much you're getting paid to wait now. The dividend yields are so attractive.
Right.
So that's always important. I know,
especially relative to the alternatives, right?
There is no alternative, right? And no, it gets so tough to see the bull case when you get market action like this.
Right.
But that's why it's hard. That's why it's hard to be a great investor, right? Sometimes you have to plug your nose and buy stocks because you know it's the best thing for you. And these opportunities don't happen often.